Welcome back to Current Topics in Finance. I am Andy Kim, your Dr. Finance. Last time we went through the size and value factors as a basic for quantitative trading strategies. Before that, it was momentum that you worked on. Now, talking about value factors, you can find out and then try your own ideas like profitability or any kind of fundamental numbers. Just line up and sort your companies, like the whole companies in the stock market, thousands of them, based on certain criteria, and then see if you can make money by taking some short and long positions based on those criteria. If you have positive or significant returns, right, you have a goal. And moreover, if you can test it through capital asset pricing models, alpha, or whatever factor alpha, you still have a go, right? You have good strategy. So that's one thing you could try for your project, right? This approach is more of a cross-sectional approach. What do you mean cross-sectional? For a given time point, you have a cross-section of thousands of stocks, right? Cross-section of those stocks, and then you find a pattern cross-sectionally, different patterns. Some stocks give you better returns than other group of stocks. You take long, short position. Okay, you see the return difference. That return difference should be excess return and may work nicely as a proxy for risk factors or risk premium, right? So it goes all together with that. Now, the next approach would be more closely related to more of a time series related approaches, right? Time series instead of the cross section. Time series, what do you mean? Well, as time goes by, for a given stock, one single stock or a group of stock, does that show any pattern? For example, a short run overreaction or delayed reaction kind of things, right? Based on that, maybe you could take some, profit-taking opportunity, right? Short sell when there's overshooting, right? That kind of things. We're going to try it. So reactions to news and no news is the topic over here, right? What moves the stock price by Cutler, Poterba, and Larry Summers, a Harvard professor. Was a seminal paper about it, right? They went through a series of events, right? News events like Japanese Pearl Harbor invasion, surprise attack, or some countries going into wars like Korean War and the Pacific, war or something, right? Those kind of news events really generated significant stock price responses, like usually negative response over here. War is a negative event, right? Because it increases in uncertainty, which never helps the value of most of the companies. But surprisingly, what they find in the next table was that when you look at the magnitude of the return of this given date, right? So for trading dates, it is not the specific event that drives the most significant price changes, but it is usually the sentiment or the psychology that drives the most drastic price movement, right? Price movement. I should be careful in my choice of words, right? Price movement. So Eugene Fama always said, on average, it should be the information that drives the stock price. Okay, nothing else. Nothing else matters. But behavioral finance guys like Larry Summers, they find that it's questionable. Other than information, something else is driving it. Part of it is sentiment, something we call it. Another part of it is more of a attention, media-driven attention kind of things. Why is that the case? Media-driven attention? Well, the basic presumption or assumption in the traditional economics theory is that all the investors in the market are fully aware of all the existence of all the companies in the stock market, like 6,000 or in the Korean market, 2,300 companies listed in the Korean stock market right now, assumed to be known. Like it is assumed that you are aware of all those companies, right? We call it complete information market, right? So under that assumption, they have been building up those economics theories, right? But the thing is, in reality, we are not fully aware of those 2,300 companies. In fact, I cannot remember 23 different companies right at this moment, right now. Only, handful of them are remembered in our brain. We have bounded rationality, okay? So we remember and then we pay attention to those stocks that receive media attention and get spotlight, right? And then we overreact to those small group of companies, right? For other companies in the dark, we don't respond. Our response will be delayed, right? So we see overreaction for small group of companies that receive media attention, and then delayed response for the companies in the dark, right? So that's what we can infer from the bounded rationality theory by Nobel Prize laureate Herbert Simon, right? Now, what's the typical case study about this media-driven attention? Well, what is this? You remember this? Right. Gangnam Style, right? So what I'm trying to show you here is that, where is it? Yeah. My study about Gangnam Style in 2012, the published paper in 2016 was about Gangnam Style's videos, music video getting popular. Can you hear this?
Pop quiz. Oppan Gangnam Style. What do the following have in common? The 2012 hyper-viral video sensation Gangnam Style, the hottest, sexiest CEOs alive, the 2013 Nobel Prize in Economics. To help answer that question,
so
a deeper one about the rationality of the stock market.
Please go ahead and watch this video, and then you will see what I'm talking about. There's a series of events that you should, the series of interesting studies that has a lot to do with this media-driven attention. The thing is non-informative or non-informational media-driven attention drives the stock price as well in a very systematic manner, right? So that's a very interesting stock market phenomena that you see. Here what you see is the stock price chart of DI Corp of Psy's daddy's stock, Gangnam Style stock, right? DI Corp, semiconductor manufacturing company. Actually, the testing machines, 반도체 장비 회사. And over the year of 2012, there was not much of an informational event. No mergers or no earnings surprise or anything at all. Okay, their businesses were just going as business as usual. But what was interesting was that the CEO's son, Psy, happened to be Psy, his song Gangnam Style took off, right? And then got extremely popular all around the world. Together with this Gangnam Style's YouTube clicking, right? You remember that it was a historical record high all across the globe, right? He was the first one to pass that billion clicks, things like that. But the thing is, together with this song getting popular, the news that his father, right, or Psy's father, he's a CEO of a listed company in South Korea, was publicized in The Economist the British news media as well as other news media all around the world as the song got more popular and popular everywhere like this. The thing is, flash maps took off every places, and then different countries and different regions of inside Korea. What I found in my paper is that I have a trading volume coming from all different countries. I have the nationality identification for all 250 different nationalities. Whenever there is a flash map going on in their countries, the subsequent day, I see a significant jump in individual investors' purchase about size that is stock in that country. British, French, or whatever, you name it. Vietnam. And then within Korea also, whenever there was a flash map going on in their own town, they celebrated their town because the title of the song was Gangnam Style. Gangnam, the area name. So Gangbuk over here, well, whatever, Myeongyun style or whatever. And then whenever there was a Myeongyun-dong styles, like a Gangnam, the flash map was going on, the next day of the uploading, right? I saw a significant increase in purchasing of the DI Corp stock, and then which was pretty much telling us that the individual investors were excited about this kind of media-driven attention, and then they are the driving force behind this kind of a temporary bubble and bust like this. So go ahead and watch it. Not only that, but also CNBC interviews or CEO interviews on CNBC is a similar event, because the CEOs, they cannot say something new, important announcement in limited news media like CNBC. Yeah, CNBC is the biggest news media in television-wise in the US, but it's still a cable television. It's not for public, it's not commonly shared by everybody. The thing is, disclosure of new information has to be fairly disclosed. Regulation fair disclosure, we call it. So that the companies, their initial announcement has to be done through SEC's EDGAR website. So CNBC television interview, the CEOs will be speaking about, saying something about some stale information, stale news, right? Old news, right? So old news, should the investors respond to this kind of old news? The answer is no, according to Chicago Minnesota economist, right? The stock price should be responding at the first second of publication of those information. But why, but if you look at this instantaneously, the price has to respond in initial moment. But as you see, the price responds positively even when there is a CEO interviews on CNBC, stale news, right? They responded. So if you are a hedge fund, and respond like this up and then reversal back to the original level. These are the trading days, right? So this is a day of the CEO interviews. And then as you see the price movement of upward and downward like this, overreaction, driven by media attention, bubble, what should you do, right? As a hedge fund manager or quantitative traders or algorithmic trader, well, watch the television and simply short sell the stock and wait over here and then buy it back. That's your best strategy. And this turns out to be perhaps the most profitable and easy trading strategy for hedge fund managers over the decades or something. Not only that, you watch the television by Jim Cramer, and then he recommends certain stocks, but as it turns out, he's not that good in stock recommendation. He's just good at drawing attention. Even though he's a Goldman Sachs banker, ex-banker, and then he manages hedge fund, the stocks that he recommended, hundreds of them, people tested that the recommended stocks are not performing as good as it should. It's just a neutral. But he is good at drawing attention and giving highlight to certain group of stocks. So what happens to the stock price for the highlighted stocks? Well, on the day of the publication by the publicizing by Jim Cramer, the price jumps and then reverses back to original level. quite similar to CNBC interview, CEO interviews response, right? So what you do, watch television, short sell the stock. That's it. That kind of phenomena is even stronger for smaller stocks and illiquid stocks. But be careful, these illiquid stocks are difficult to short sell because not many funds hold this kind of stuff. So that's why it takes a longer time for them to come back. There is some significant, limits to arbitrage. There is a short seller's risk is there. It's called noise trader risk is there. But even without that, like big stocks, we see these kind of patterns. Definitely you have to short sell these guys. This is a time when the individual investors will be like, oh yes, I know that stock, I'm going to buy that one. Giving money to those hedge funds who will short sell it. That's it. So hedge funds, easiest to algorithmic trading was like that. And here's one of my souvenir picture when I was visiting NYSC. Yeah, Jim Cramer was busy, talking, and then I was just looking around in the trading floor. Somebody took the picture of me. And then investors make systematic mistakes like that. Stale news. You should not, if you are a smart money, you would not you will not buy it, right? And then you will not pay, attention should not be, driving the stock price like this. But there are some individual investors, you are really working like that, okay? Making mistakes in a systematic manner. For example, similar named companies, the companies with similar ticker or something like that, they move together like that. And here's an example of Twitter, right? The social media company SNS, like Twitter, and then Donald Trump, right? Tweeting. The thing is, Twitter was not a publicly traded company, but in 2013, right? In October time, like this time around, 8 years ago, the private company, the CEO realized that, oh yeah, our company is doing great. So I think we're going to go through, we will do the IPO soon. 6 months later, we will do the IPO. They announced it. They were going to go through the IPO 6 months from then, which means their stock is not traded in the stock market at all. But there was a company called Twitter, right? Twitter, what is it? That's a home theater kind of speaker company, okay? Bang & Olufsen, that kind of company. And then that stock was traded at 1 cent per share or something. And then some of the individual investors got so much excited about the Twitter CEO's announcement, and then they said, I know that stock, I'm going to buy Twitter, a similar ticker, a similar pronunciation, and they just purchased that stock at almost like $15, 15 cents or something. 1 cent to 15 cents within 10 minutes. Somebody purchased this one over here, must have earned like 15 times the amount, okay? And somebody purchased over here, must have lost almost everything there. So they make mistakes like this, but this gives an interesting profit-taking opportunity for smart money. Similar pronunciation companies and things like that, similar ticker symbols and things like that. You can trade on it, maybe. Algorithmic trading. Systematic mistake will be there because of the bounded rationality of individual investors. Thou shall make mistake. It's like 11th commandment, right? Reaction to news and no news, yeah. So, is there any underreaction? Could be another story, right? I told you about the overreaction story. Any underreaction, right? Delayed response? Yeah, there could be some delayed response as well. That's something called post earnings announcement drift, which is PEAD. PEAD. In few months after the earnings announcement, stocks earn abnormal returns. So quarterly earnings announcement, the companies do it, right? This quarter we earned this much or that much. There would be some surprise, right? Positive or negative surprise, or it could be within expected range. But to the extent that there was an earnings surprise, the price has to respond on the announcement day immediately and to the full. But researchers found out that it's not that full. It's rather what they find is the delayed response. Delayed response. We call it post-earnings announcement drift. Drift. What do you mean? You drive a Lamborghini perhaps at full speed and then make a turn 90 degrees. Then can you really make a sharp turn like that, or drift it around like that? Or is it? This is what I'm talking about, right? It's a drift happening. Okay. So post-earnings announcement drift has been reported. Why do people, like this, right? Why do people respond belatedly? I said before, attention versus non-attention. If the earnings is announced when the people were not paying much attention, rather they were paying attention to other stocks, and this stock was excluded from those attention, then you should take some time to the price to be converging to the correct level, right? Now this is the typical graph that you see about the PEAD. How do you do it? Well, out of thousands of stocks that do earnings announcement, right? 2,300 different companies in Korea, or 3,500, right? 3,500 companies in the United States. You classify or group or sort the companies in terms of earnings surprise degree of earnings surprise. The degree of earnings surprise, there would be, positive earnings surprise versus negative earnings surprise. Earnings surprise, how would you measure that? Well, look at the PE ratio. No. Look at the EPS, right? Earnings per share figure. Earnings per share. Some companies will be announcing earnings per share that is within the range of, market consensus. The analysts in the market has been expected as such, so that there will be no earnings surprise. There will be a group of companies that there's no earnings surprise, but there will be some group of companies whose EPS actual announcement, is way above the market consensus expectation. Those will be over here, and some other companies will be in the bottom over there in terms of the earnings surprise, right? Compared to the consensus EPS amount. So you can think about the spectrum of earnings surprise for the companies. So out of those earnings surprise spectrum, divide into deciles, right? 10% top all the way down to 10% bottom, right? Quarterly earnings surprise. Then what do you do? Well, for that, 10% each deciles, right? Each deciles, you do event study, stock market event study for the respective surprise group, right? So this is the day of earnings announcement, and then what you see on the left hand side is the stock price response since minus 60 trading days, like 60 trading days before the actual earnings announcement. See what happened for each group of companies, right? All the way down, most positive to most negative. You can see that those group of companies with the most negative earnings surprise, well, the price already starts to incorporate those information a little by little, right? There is a pre-announcement movement, okay, like this. On the day of the announcement, you take out the daily response of the earnings announcement date. Why is that so? On the day of the earnings announcement, the magnitude of the response will be hugely different. So that's not what we are interested in, by the way, because that's market efficiency test, just showing that market is efficient. As long as you have negative earnings surprise, it will be like huge going down. So positive, it will be hugely going up everywhere. So remove that day 0, and then starting from day 1, you stack it to the right hand side. Okay, what you see all the way up to day plus 60 trading days from the actual earnings announcement date. What do you see? Well, your benchmark is that over here, everything is announced already. I mean, isn't there earnings, other news coming in over this news announcements on these other days? Well, let's just forget about it. Let's assume that the important announcement is about the earnings announcement only, your quarterly performances, right? So over this period, no information, and then what is expected is price movement being completely horizontal, right? Completely horizontal, which means silent, right? But what they find is that, what the researchers found is that there's significant price drift like this, especially for the extreme ones, positive degree and negative degree, okay, negative degree. And the direction keeps on being in the same direction, okay? And the question becomes, why is there some delay like that, right? Number two, is there some profit-taking opportunity, okay? So if you're a hedge fund, what would you do? For this kind of positive earnings surprise extreme group, take a long position. And for this kind of negative extreme earnings surprise group, what do? Short sell and then cover your short position at this point. So you will earn this amount of money. Short and long. Long short position, how much would you earn money? Well, this amount of magnitude and that amount of magnitude altogether, okay? That will be like about what, 4 percentage point or something, or more over the quarters, right? So it looks like the underreaction to information in an earnings announcement is found. Drift spikes again at subsequent earnings announcement dates. Bernard and Thomas are the ones that reported this kind of PEAD phenomena, and then this is clear violation against semi-strong for market efficiency. Semi-strong for market efficiency says what? Well, there's a clear benchmark. After the announcement, there should be no drift, which means it has to be flat like this, right? Either, as you see in the middle part, there's not much of a drift. I would rather say they are flat like this. But other than those, right, these guys are showing significant negative drift and positive drift over there as well. So violation of semi-strong for market efficiency. All right. Yeah, and then this kind of things, right, is done by event-driven hedge funds and algorithmic trading. And then we're going to, what I'm showing you over here is the event study result for M&A target companies, right? M&A target companies. Merger arbitrage is there as a trading strategy for hedge funds. But what you see over here is the typical price movement of a company being taken over. And the day zero over here is a day of announcement about this company is being taken over by other companies. And usually those acquirers pay significant amount of premium to the target company and merger premium. And then, the price response, right, is very immediate. You see like about 10% or 12% response is going on over there, but it does not appear to the full on the first day of it. It takes time. And then there's a probability that the deal M&A will fail. So they don't reach to the target level immediately, but it slowly goes up, right? But the semi-strong for market efficiency, pretty much it is confirmed over here. On the day of the announcement, the price response happens instantaneously, just like the event of Yahoo's being taken over by Microsoft in 2008, right? So, and another thing that I want to share with you is that there seem to be some leakage of information about its target company being, taken over, even though there's a Chinese wall enforced, right? Has to be a secret, but somebody seemed to be leaking information for some companies, right? Not so much for big companies, but small companies which is less monitored. Yeah, they would suffer this kind of things. Anyway, the important part is this, And then merger arbitrage, right, is about this kind of target companies, and then the acquire a company. And then there are some people who can still make money by buying the stock at this point, the first day of announcement, and then sell it subsequently, right? And then PEAD, I showed you about this. All this kind of stock market event study, we're going to do that in the next video, and then set of videos, right? I will show you some of the R codes related to this. All right. Thanks for watching.